Hello, Jim here. We've had a couple of rough weeks in the market recently. Do I think that's going to continue? I do believe it will, but at some point it will end. I still think we're going to have a V-shaped recovery. So when it does end, I think a lot of the stocks and ETFs are just going to shoot up. This is at least what I'm thinking. I don't think we're going to hit new lows. If we do, it'll be because of some other news, not the tariffs. I believe the tariffs are fairly baked into the market at this time. Of course, I could be completely wrong, and but it would need to be something bigger than the tariffs, or something with the tariffs that are more significant than any of us have expected up to this point. So I think we're going to be choppy, and the market's going to kind of go sideways. So and the volatility will probably continue to be very high, meaning it'll be some good times for options traders to make some very good income related to premium. Today, I want to talk about several positions that were assigned to me recently, one in particular, and how I'm going to do what I call my balanced shielded wheel strategy. It allows you to sell covered calls on current positions, especially ones that have recently been assigned. It also, at the same time, you can do a cash secured put or potentially a vertical put credit spread if you have the ability to do that, or if you just find a long put that's cheap. I always encourage people to buy inexpensive puts that are maybe $10 out or $5 out. Because if the market continues to crash or we hit new lows, those puts will become worth a lot more. So today I'm going to share with you this new strategy, how I do it, and then one particular stock that I really like. And it's kind of an earnings play, so it'll be a little bit different than some of the strategies I've done in the past. So be sure you stay through the end. I think it's going to be well worth your while. Now, the stock I want to talk about is Celestica, CLS. It's a stock I've mentioned before and some other videos. They've been hit pretty hard, and I believe they're fairly oversold. They're one of the bargains I like to talk about. So, and we'll take a quick look at them, and then at the end, I'll actually go through the setup of the trade and what it potentially can look like. So here is CLS, Celestica. Earnings per share, $4.62, so quite a bit, or is that 482? So they've got a PE of 1742. You can see here, if you look at 1 year, they were as high as 144. They've come down quite a bit. They, if we look at profitability, they don't have the best profitability, primarily through gross profit margin, but they're improving that. So I think this will probably improve. They do have good return on common equity, good return on total capital, return on total assets. So, and that's even with such a low gross profit margin. And then they have B plus for cash flow from operations. Cash per share looks good. So profitability could be a little bit better, but I do think it's going to improve. Let's look at growth. Growth is currently an A minus, so they have good revenue growth year over year, good earnings growth. So overall, some pretty significant growth. Which I like to see, especially with a company that's been around a bit. Valuation. So let's look at valuation. It's C plus is what Seeking Alpha is giving it. I like to look at this capital structure. So they're just shy of a $10 billion company. Then they only have 931 million in debt, which is, that's fine. It's not too much debt. It's way or well below the 50% debt to equity I like to look at. They also have 429 million in cash, which is good. And like I showed in profitability, they bring in quite a bit of cash. And then if we look at PE ratio, it's going to be 2168 for actual of 24, 25, 1742, then 1430 and 12. Earnings, they did recently, or they are going to have earnings coming up on the 24th. So it's up. Their earnings are coming up this week, but that's one thing I like about them. They're one of the positions that were assigned to me, so I currently do own 100 shares. So I'm looking at selling a covered call, and selling a covered call when premiums are through the roof because of earnings, it's typically a good time to do it. Um, and I like to look at the earnings estimate so we can see a little bit more detail. So 482 for 20 for 25, 6 or 588 for 26, and then nearly $7 for 27. So that'd be like a 12 PE. Um, so they definitely are going to have some good growth. Now, I also like to look at financials. I like to see that they've been earning and growing their revenue. So here you can see 9,646. They were at 7,972. So 5,8 or 5. I think that's 5,634. So they did have a little bit of a dip between 20 and 21. Um, but they did increase it some the previous year, it looks like. Um, so they did have a bit of a dip here, but that is 3 years out. Recently, they've had some pretty good growth. I also like to come down, I'll look at balance sheet. I like to see if they're buying back stock, which can work out really well for you long term if a company is buying back quite a bit of shares. So here we can look at total shares outstanding. So 116, 116, 119. So they went down 121, 124. So you can see they're buying back shares back in, what is that, 2019. They had 129. They're down to 118. So they are buying back a good number of shares as well as having a good handle on debt. So a lot of the things I really like to see. Now, one thing I will look at, and I like to do it, I like to go to bar chart and then, so let's go to bar chart. And I don't want to go to, and let's just go to, I don't know why I came up with that, but let's just go to bar chart. And I like to use their interactive charting. And then we can enter here CLS. Oh, I'm using a new laptop that I'm trying to get ready. Yeah, here it is, Elastica. So if we look at their interactive chart, which is right here, we can see, um, and let's go back. I believe this is the 10-year. I like to use the 5-year, or actually the 2-year. Let's go back to the 2-year. So you can see there with their interactive, or the Bollinger Band, they're kind of right in the middle, but they were a lot pricier recently. So I wonder what 1 year looks like. We'll go to the 1 year. So they're kind of right in the middle of the band. So if I wanted to make a trade on them, I probably would want to be closer to this lower band, which these are just primarily averages, the running average, and then two standard deviations. So two standard deviations would be in the mid 60s, mid to low 60s. Um, but I think even in around 70, they are potentially a buy. They're currently at 84.04. So um, it looks like they dipped down not long ago into the 50s, but then they bounced back, and they seem to be coming back pretty strong. Now, what I also like to look at is options prices. So if we come and we look, we'll just go out 2 weeks to 5/2, and I like to see. So they have a fair amount of open interest. They have a fair amount, and this is for weeklies. The volume's fairly good, so I like to see that. I'll sometimes go out to monthlies too and see what do they have on monthlies, and then monthlies look even better. 246, 519 for open interest, fair amount of volume, and you're looking at some big numbers here. So um, right now, and these are calls, for just outside the money, $7, anywhere from 7 to 8.60, which is quite a bit. So I'd be like adding almost $8, $8.50 to 85.50, which is a bit above where it is not now, 84.04. So some pretty good premium. Part of this again is because they have earnings coming up on the 24th. But again, if you're going to sell a covered call, it might be one of the best times to actually sell a covered call. So pretty much everything I like to see. And um, I mentioned in the beginning of the video, I had a number of positions assigned to me over the last week. This is one of them. I've also had a few others like NetApp and XLK. And I decided to keep XLK. I'll talk a little bit about it too. But my goal is to be able to do this shielded balanced wheel and sell covered calls, sell cash secured puts, and potentially make a whole lot of income in a short period of time. So I think it'll be a little bit more understandable if we do the setup for the trade and you can see how much potential premium would be brought in. So stay tuned. Let's jump into the next section. Okay, now in this strategy, what I typically do is I start out with 100 shares. You could either buy 100 shares or sell a cash secured put that, or a vertical put credit spread that gets assigned to you. It was originally a vertical put credit spread. CLS was assigned to me. I ended up selling the long put. Again, I a lot of times will buy a long put if I find that it's not overpriced. I think it's a good price, primarily because of what just happened with the market. The market dropped quite a bit. The put for CLS became worth a lot. So even though CLS dropped so much, that put gained value. So it kept me within a certain range of, you know, I think it was pretty close to $10 within wherever the stock dropped to. So I believe at one time it dropped as low as $60, but when I calculated, it was around $70. So in the end, I wanted to own them. They got assigned to me. I did have 200 shares. I sold 100 shares, and that's also purposeful. I wanted to, with this type of strategy, again, you start with 100 shares, then you sell a covered call. Now, if you can do it around earnings, that's kind of an extra bang for the buck. You'll notice in a minute when I show you what the premiums look like for CLS for covered calls, you can significantly increase your premiums during that time period. Now, I would not sell a cash secured put. I would wait till after earnings. So, if you're going to do a cash secured put, and I'll also show you the premium here for that, you would want to wait till after earnings. So, if they do miss earnings, they're going to drop like a rock, and you could potentially sell a cash secured put dirt cheap. So let's jump in. This is what it looks like for a cash secured put. I'm only doing one. I already own 100 shares. I want to pick up another 100 shares. So I would do one covered call contract and I would do one cash secured put contract. And again, I'll look and see, well, are the long puts cheap? Should I just buy them? And that's where the safety for this is. By buying that long put, you're turning it into a bit of a safer trade. Plus the fact that you already own 100 shares and your covered call is covered, it's also a bit of a safer trade compared to something like an iron condor. Well, iron condor does also protect you on the upside, but selling a naked call is fairly risky, or even just a call spread. I got assigned Microsoft years ago and took a fairly big loss with it. So I've been reluctant to do call spreads, just call spreads. I'm fine with doing put spreads because I feel like a stock can only go down so much, So if it's a $60 stock, at the most it can go down as 60, but if you're going through a crazy bull market, a stock can go up 30, 50, $100, and I've seen it happen. Like APP, that happened with them. And then Palantir, I believe Palantir has gone up 50 or $60 in the past year. So CLS, what I would do here, this is Schwab. I like to demo on Schwab. I would sell the open, one contract, a covered call, and here I'm saying $84. Now it's currently $84.10, but this is expiring on 4/25, which is next Friday. So you could do this weekly. I like to do 2 weeks. So I'll look at 5/2 and you can see it went up not significantly. So there may be a little bit of an argument to do it just with 4/25, but where it does make a big difference is as you take a little bit less risk and you go with a lower delta, like a 20 some odd delta versus this is probably, and I can look right here, I can see what the delta looks like, and here it is right here. It's a almost 52 delta, meaning it's a 52% chance it's going to be assigned away from me. And I want to keep the shares. My cost basis is right around 83. And, so I don't want to lose them too quickly. I also want to keep it above my cost basis. So I'll go out to 5.2. I might look at, let's just try 92. And again, you can earn between $340 per contract up to 380, and then the mid is 360. So, and then again, I can look at what the delta is. It's a 34.91 delta. So still a little bit riskier than I want to deal with it at this time, again, because I want to keep the stock, but I can hide that. And let's go a little bit higher. Let's try 95. And then it's bringing in between $200 and 290, which isn't bad. Again, this is for one contract and it's for 15 days. So the expiration wouldn't be next Friday, but it would be the Friday after that. So potentially you could do this every 2 weeks. Or, like I mentioned a minute ago, you could probably do them as a weekly and still do fairly well. So, um, and again, let's look 27 delta. So that's in the range I'm okay with. Plus, I believe my cost basis is 83. So by selling a covered call at 95, and I'd pick up between 205 and 290. Now, what I typically do is I'll go fairly close to the ask, and then I usually will take a dollar or two off. So I may start with 288 or 285, and then I will submit that order, review it, again, being sure that I'm selling to open. If you make a mistake and you do buy to open, you can just reverse the trade and put it through again. And sometimes you'll make a little bit of a profit doing that. Other times you might have to pay a little bit, but I've made that mistake. Most traders have done that. So I would sell to open one contract CLS with a 95 strike call, and I would hope to own it or earn 288, not own it. I already own 100 shares. So in a sense, when this went through, especially it's in my IRA, so my cost base is, if I pick up 288, would go down, and again, this is on one contract, so it would go down per share by $2.88, and that cash would end up in my account. So for tax purposes, those shares would look like, instead of being 83, they would be closer to 81, we'll just say 81.20 or something along those lines. Now, if I did this and it didn't get assigned to me, and let's just say that the market, I believe their earnings is April 24th, say they miss earnings, well, they could drop all the way down to, let's say, 68. So if that happened, then to close this position would be probably 30 or 40 cents on the dollar. So I could potentially close it for 60 or $70, which would be pretty close to a 60 or 70% profit, which I would then do that at that time and look at potentially doing another covered call fairly quickly. One thing about earnings is they usually, if they miss earnings, they'll drop and then they kind of recover and slowly regain it. It also depends on the guidance and how big they, or how, do they miss earnings by a lot or just a little bit? And the reverse is also true. If they have really good earnings and they shoot up, it again usually drifts back to the mean and comes back down. So if you take that profit, then you can probably set up another trade fairly quickly, maybe within another week to 2 weeks. So, and again, if I do that, then I would do another trade a lot like this. What I found with CLS, they typically always have better premium than a lot of other companies. So I would hope to earn pretty close to this again, maybe a little bit less because earnings is so close. Now, if I did a put, then I would say, well, I want to again sell to open, but we can just look at what the premium looks like for a put. Everything would stay the same and we're just playing with 2 week period, but I would change this to a put. And of course, I wouldn't want to leave it here, but we could say it's currently 84. Let's just look at 80. So bringing in, and this is for one contract, $460 to $580. And then I can look here, it's a 37 delta. with this market, I probably want to go lower. So let's just say I go to 75. And again, look at the delta. It's a 28 delta. I like to use 15 deltas, and it's not a perfect delta. It might be an 18 delta, a 19 delta, or if in the instance there's a 12 delta and then a 22 delta, I'd probably pick the 22 delta. I like to take less risk during these times, at least until the tariffs are kind of ironed out. But when I do see that the tariffs are coming to an end, meaning, we know what they're going to look like going forward. Trump is negotiating and changing, expectations. Then I might take a little bit more risk, but during this market, I'm taking less risk. So here, 75 is still probably too risky. I might look at 70, and then again, I would look. This is right at around a 20 delta. So I could even go a little bit lower. So I could do 68, and then let's see what delta that is. That's a 17 delta. So I could earn anywhere from $1.50 to 3.30. Now these numbers may be a little bit. It's over the weekend. It's Sunday, Easter Sunday. So I wouldn't be surprised if it's a little squirrely. But again, I would pick the 3.30. Then I would go a little bit lower. Maybe I would do 3.25, and then I would try to get it filled. I would again review the order, make sure I'm selling to open, make sure the quantity is correct, that I'm working with the right stock, that I like the delta. This is really important to take your time when you make the trade because you really don't want to, make a mistake. So if everything looks good, then I would review it. I would fire it off. And then if it gets assigned to me, meaning the market does drop, I would pick it up right around 65. And if in that interactive chart I did earlier, that's pretty near the bottom of the Bollinger Band. I personally think it could shoot up. It may get back up into the 90s. So, but in the process, you're earning potentially $325. Now, what typically happens is with any of these brokerages, if it doesn't get filled, meaning no one out there may be willing to pay 325, I'll then within the brokerage itself, you can typically replace the trade or edit the trade, and that's what I'll do. I'll change it a little bit. I'll lower it a little bit. So maybe next time I do 320, then 315, or when I'm replacing it, if it's pretty clear it's not going through very quickly, then I might click on mid and I might use the mid value. So I might try 240. Especially again, this is one contract. I like to earn 100 per contract on most of my trades. So this is a very profitable trade. And this, so at this point, if it gets assigned to me, I'm picking up some shares really cheap. Plus, I'm picking up premium along the way. So I would have sold a cash secured put. I already have 100 shares. If that cash secured put, if I want to turn it into a vertical put credit spread, I can add another leg. Then I could say, instead of sell to open, I want to buy to open. And then I can see, well, what does this look like at 50? We'll go all the way out to 58. So it's not cheap, 10 cents to 205. And this dropped all the way to 133. So in this instance, now one thing I typically will do, I'll look at 57, and it did jump a bit. Actually, I went the wrong way. I'd want to look at 59. So it's getting lower. So this is one instance that I probably would not. Let's just try something like 61, which that actually jumped up. So 61 may be better than 58. And I have seen that, and it's weird. It's right around that $7 mark. So the spread would be the difference between 68 and 61, that you could potentially do better. So I always encourage people to take a look. Now, CLS, the puts are pretty pricey typically, but other companies they won't be if they don't have as good of premiums and open interest and volatility. Then you may find that the puts are dirt cheap. I found puts as cheap as $2 or $3 a contract. So I always like to look. So in this case, I'd say, well, I don't really want this, so let's take it back out. And now we're back at a cash secured put. Funny, the numbers change, but just because I need to do this, I'd have to go back. And again, I would fill this, or I would try to fill this. I would open the trade. then again, I would replace the trade, hopefully having it assigned. So this is what I wanted to share with you guys. I also have two other positions. I'm looking to do the same thing. Actually, I have around 8 or 9. So the rest of the month, I should be able to sell some really good covered calls, depending on what the market looks like. If it's down every day, then I typically tell people on green days sell covered calls, on red days sell puts, cash secured puts, or vertical put credit spreads. Um, so here are two others that I looked at, and I just played with the different premium. An XLK, which is like QQQ, but it's iShares and it's not quite as expensive. So um, I was looking at its call premium and using a 26 delta for the call, I could bring in 239. This is expiring on 5/16. So it is truly almost like a month. And I could pick up some pretty good premium. For the month, I could do 476. And then yearly, that would be 5712. And then required capital would be the cash secured put. I'm not typically looking at the value of the current shares, but it's the required capital if I get assigned more shares, and then I can look at what kind of return that looks like, which would be like a 33%. So if you were successful with running this trade, again, that's better than most people can do. And that's only doing it once a month. And it's an ETF, which typically has been safer. XLK is the first ETF that's been assigned to me in a long time. I've run, I had done previous trades with it and it hadn't been assigned. I've had XLE. There's been a number of positions that have not been assigned to me related to ETFs. I find ETFs a little bit safer to trade than stocks. They typically don't have as good premium, but it can work out pretty well. Now, and NetApp is another software company I like, and part of the reason I like looking at these software companies is the fact that um, you know they're not as impacted by the tariffs. You know, they may be impacted because hardware may become a little bit more expensive, or maybe the hardware services might become more expensive. But typically, they're not as impacted. So NetApp's another one I like. I would look at doing a call around 90. I believe it's currently 93, 94, but a fairly good premium, not as anywhere as good as CLS. Again, CLS has got earnings. I think NetApp has earnings coming in early May, so this is one position I may wait closer to May as I get closer to earnings to potentially sell a covered call, because the same thing that's happened with CLS will happen to a certain degree with NetApp. I don't think it'll happen as much with CLS. I also, and I forgot to mention this in the beginning, I like CLS because they do supply chain software and they do manufacturing software. So if we're onshoring a lot of manufacturing, they should do well because their software is going to be used in a lot of these new manufacturing plants. And for the supply chain, they're also going to be used quite a bit. NetApp's another one I've used before. I use AWS, Amazon Web Services, and I also use Azure with Microsoft, which NetApp is one of the tools that you can use within the cloud. And so they were assigned to me last week, and I really like owning them, and I'm looking to own more. So I could also earn around 135 in premium, and again, this is going out monthly, so I'd make around 250 yearly. That's around 3,000. So the return's a little bit better than XLK, but and this isn't considering if I did a vertical put credit spread, then the yearly ROI goes up quite a bit. But again, this another good company, another good opportunity to make a trade. And in my CLS trade, I was just showing what it would look like. I actually use 70, which when I looked at it I think in bar charts, it showed a different value than what I saw with Schwab. But I would bring in 515 if I was able to do this just once a month, and then for the full year, that'd be 12,360. And then if I looked at required capital, I would only need the 7,000. And when I showed earlier within Schwab, which I think is still up over here, yeah, I would only need 68. 6,800 minus whatever premium I brought in. So these numbers are actually a little bit higher. The return would be a little bit better. So these are the kind of trades that I'm sharing with my membership. And I'll be sharing these more. I'm trying to make it easier for my members, making some modifications here and there so that they, um, you know, can more easily follow my trades, as well as when I post my trades within Patreon as well as Discord. I give a lot of detail. I also talk about if I'm rolling something, what what strikes you might want to use if it's a new position. If you want to take less risk, well, maybe you should go with a lower delta. So I go into a lot of detail, and I also go into a lot of detail why I like the company and why I think they're going to do better or perform better than a lot of other companies. So if you're curious about my memberships, details are in the description. I am going to do a price increase. I don't know if I'm going to do it the beginning of May or potentially the beginning of June. My current members will be grandfathered in at the current rates, but just want to give people a heads up that the rates will be going up, especially for my coaching. Since I'm a software consultant, I can't be charging one person, you know, 4 times more than what I'm charging for coaching with this stuff. I set my prices way too low, so coaching will be going up. So as always, thanks for taking the time to watch. If you disagree with me on something, please leave a comment. I try to answer all my comments. It's something I really enjoy doing. And I like having these conversations back and forth, especially if you don't just, don't be rude. If you disagree, just share with me why and how you would do it different. So thanks again for taking the time to watch the video, and hope you have a wonderful weekend, or what's left of the weekend.